and it goes through and it talks about like retirement readiness, and it scores your portfolio, and it calls out what's really good and like where's some opportunities for improvement. And importantly, it benchmarks you. It compares you to other investors on your age, your net worth, your risk preference. The difference that we made, this absolutely massive change.
You have found Authentic Business Adventures, the business program that brings you the struggle stories and triumph and successes of business owners across the land. Downloadable audio episodes of the podcast can be found at drawincustomers.com. We are locally underwritten by the Bank of Sun Prairie, Calls on Call Extraordinary Answering Service, as well as the Bold Business Book. And today we're welcoming / preparing to learn from Alexander Harmsen, co-founder of PortfolioPilot.com. And we're going to learn about investing in AI. So, Alex, how are you doing today?
Doing really well. James, thanks for having me on the pod.
I'm excited because I like to think of myself as an investor. I'm not going to say a smart or good investor, though up until maybe a month ago, I thought I was the best in the world, right? And then things changed. So let's just start with, what is Portfolio Pilot?
Yeah, it's so much of it is about our own psychology, right? Or perceptions. And investing feels like it's a lot about controlling fear and probably controlling greed as well, depending on whether things are green or red at any given moment. So we can get into this later, but I sold my previous company, an AI startup that I ran for 6.5 years. We sold it in 2021. And then, basically we bought a house in the Bay Area, started a family. We have 2 toddlers now. My wife runs a biotech startup as well, like really cool, post-Series A. They've raised a lot of money for that. And in 2021, I sort of found myself trying to figure out what's next. And, took out my coding gloves for the first time in a little while, and, built a bunch of companies on the back of a napkin and prototype things. And sort of at the same time, we started talking to financial advisors and wealth managers. And I don't know, it sort of feels like I got put on some list at some point because I was fielding calls every other couple of days. I don't know, felt like the thing to do, right? First time in life we had any sort of real liquidity, and like, let's get a professional involved in, let's get an expert involved in managing our money and investing. And I did a little bit of crypto investing, and I had a Robinhood account and, 401k, and, we were thinking about setting up a 529 for the kids, and, we just bought a house, and all these things. Like, it felt like there must be things we can do to optimize this, improve it. But it just felt like every single financial advisor I was talking to was more of a salesperson than they were, an expert that was ready to just, dig into my finances and investing and like put me on the right path. And I assumed at first I was just talking to the wrong people. And after talking about 20 to 30 of these wealth managers, financial advisors, I realized that this is the game. They have some central fund, and they're mostly just salespeople trying to get you access to that fund. And they're charging 1%, sometimes 2% fees plus mutual fund fees, and kind of feels like there's conflicts of interest and human bias. And crazy thing, it wasn't even tied to performance. It was just 1% every single year, regardless of what
win or lose
happens. And then they're sort of on to the next client to try to figure out, like, how do we pull in more assets under management? And what I wanted was a coach. I wanted to be somewhat involved and make some of my own decisions. And robo-advisors didn't really feel like a reasonable alternative. It was only a small part of my money, sort of lowest common denominator advice, putting some money into ETFs and equities and bonds. And then there's 1,001 trading apps and Bloomberg Terminal for retail investors and Wall Street Bets and Motley Fool and CNBC and all kinds of trackers and screeners. But I didn't want to make this a hobby or a full-time thing. I wasn't excited about day trading and technical analysis and looking at all the numbers. What I wanted was something between. And so basically I built something for myself in a couple months. And over the last 3.5 years, that's turned into PortfolioPilot, which now has, over 30,000 users and $30 billion of assets on the platform. We're actually a registered investment advisor with the SEC, so we can give real fiduciary financial advice. And the main idea is PortfolioPilot is a personal AI financial advisor that doesn't have control over your finances. You stay in control. It's best for DIY investors, self-directed investors. You plug in your net worth. You answer a bunch of questions. You can connect accounts. You can take a screenshot of your account, whatever it is, retirement accounts, crypto, cash, credit cards, real estate. It all gets connected. You can see it all in one place. It scores everything for you, gives you a full assessment. And then we can actually give you personalized financial advice and say, James, based on your goals, based on what's happening in markets, you should sell, $4,000 of this stock you hold in your portfolio, or you should buy, $8,500 of this commodities ETF because this is what it's going to do for your portfolio, and here's how it's diversifying, and here's how it's going to increase your downside protection and expected returns, and there's forecasts and a view to the markets. And because it's completely automated advice, we can get very personal to you and your situation itself. Because we're a registered investment advisor, there's an alignment there in interests, and there's a whole bunch of compliance stuff we need to do to make sure we're giving compliant advice. And that seems to fill this incredible niche of people that want to be somewhat involved, but like the idea that you could have an AI do 95% of the work for you, and then sort of bring you a menu of different options that you can act on. And it's it's investment advice, it's tax optimization, it's thinking about cash management, long-term, short-term liquidity needs, estate planning. It's thinking about scenario modeling and retirement. It's running crises simulation through historical crises, and fee optimization, all in one sort of proactive platform. And so it's not just ChatGPT, open box. We've tried something like that 2 years ago, but we found that what people really want is they want our system. They want an advisor to sort of bring different opportunities to them, because they don't actually know the question to ask. I mean, if you know the right question to ask, you can get the answers, right? There's 1,000 other tools, including Google search and ChatGPT itself, that can answer the questions for you. The big question is, what should I ask? What should I be paying attention to right now, right? If the markets have crashed, which, the last couple of weeks, probably people should be looking at tax loss harvesting opportunities. And that seems crazy to say, because that feels like a year-end, December thing.
Yeah, we're in March right now. Yeah.
But there are tax loss harvesting opportunities that open up throughout the year that you could take advantage of in moments like this, and you could book those losses, trade into something similar, and those potential opportunities might go away 3 weeks from now. And if the market is up compared to where it is today, those opportunities might be gone if you just look at it once at the end of the year. And so there's things like that there's lots and lots of those little tricks and optimizations that you could be applying to your own net worth, financial situation, on a monthly basis, right? We send an email out, you can log into the platform, but we send an email out once a month, start of every month, just saying James, here's the top 3 things, we think you should do. It takes 10 minutes to act on this, and even just that helps people feel a little bit more confident, feel like they're a little bit more on top of their finances. And, in some ways it feels very niche, but by our estimate, there's probably somewhere between 20 and 50 million Americans that are actually in this situation, but they don't want to be completely passive, handed off to someone. I don't want to look at my money until retirement. And on the other extreme, there's sort of the day traders and hobbyists. I think most people actually fall somewhere in between where they want to be somewhat involved and, they just need a guide. The more personalized it gets, the better, kind of like every other consumer product we use in our life, right?
Fair.
Netflix actually gets better every single time I use Netflix, right? Every time I say like, no, ignore, oh, that's an interesting show. That's a movie that fits. And so this is like this idea of recommender engines throughout everything that we do that just keep learning about us and keep getting better and better and better.
So I want to ask you a quiz you about the AI stuff a little bit. Let's downshift a little bit and talk about your first business, or I guess I don't know if it was necessarily your first, but that business you sold that was involved in AI in 21. AI, I mean, ChatGPT came, what, November 22-ish, something like that. Is that right?
Right.
So you
Yeah,
were
something
way
like
ahead of
that.
the curve there, it sounds like.
I was doing AI, when it was still called deep learning, even before deep learning, neural nets, even before neural nets, I was working on expert systems and machine learning algorithms. I mean, even when I say AI for PortfolioPilot, like there's some stuff that we're using LLMs for, some web scraping, some summarization, thinking about like just translating stuff into English for, regular people and investors. But like when I say AI, I also mean like there's these dynamic factor models that we use to think about modeling interest rates and thinking about GDP and inflation. And like this is stuff like the central bank uses, the Fed uses dynamic factor models for some of its simulations and like mapping out macro conditions. We use multivariate machine learning forecasting models, for some of the underlying risk assumptions and expected returns across the system. We are using regression models to think about like exposures of your portfolio to changing inflation conditions or, GDP or raw materials risk. What happens if the price of oil spikes? That's going to affect the downside protection in your portfolio. And so AI is like, I mean, it's a whole spectrum of things. And I think recently it feels co-opted for, LLM everything. But even then, like, everything we do on the coding side, right? We're using large language models for, and we're a 10-person team right now. I think we're operating at the same output as our 25-person team with Iris Automation in 2019.
Wow. Okay.
And like, I like to think I'm a better manager and,
We all
but like,
do. It's all good.
yeah, of course, right? I mean, if I think back to some of the mistakes, but like, that's not where this, 150% increase in efficiency is coming from. It's not like we've hired smarter people. I like to think we hired for some pretty smart people at Iris as well as, with PortfolioPilot. It's the tools we're using. It's like, it's everything coding, marketing, product design. And I mean, that's made like an absolutely massive difference. But even then, like even in 2015, probably 2014, I was working on NASA as part of, basically we were using neural nets and computer vision models. And this is like super, super early. Like if you trace LLMs all the way back, you can trace them back to these like very early computer vision models around ImageNet and AlexNet. And like this is the kind of stuff we were doing, like using to do object recognition. We were working on something called Mars Helicopter. Basically, the little drone that landed on the Martian surface a couple of years ago. I don't know if you remember that in the news.
No.
But basically, like with the rover, there was a little helicopter drone that like, was exploring the Martian surface. And we were working on that in 2014. And you might think that the biggest challenge there is like the atmosphere is so thin. How do you like keep it in the air? The bigger problem is like there's no GPS system. Positioning on Mars is really difficult.
Oh.
How do you keep track? How do you know how close you are to the surface? And so we were building computer vision like navigation algorithms to be able to like figure out just how close we were, and just imagine rocks in the desert, outside of Pasadena, in LA, and trying to simulate like what it might look like on the Martian surface using these advanced machine learning computer vision algorithms. I mean, absolutely like super, super early AI stuff, robotics. And then my previous company was like all computer vision, navigation, massive simulation environments, autonomous vehicles. And I mean, it feels like we were really pushing the edge of like what we could do with AI at that time. And like so much of it translates, right? It may feel completely different. Fintech for consumers versus, autonomous vehicles, but like we had to get regulatory approvals. We needed to work with the FAA and other civil aviation authorities. Running a business can't just be some R&D research lab, right? We don't have the resources of, Waymo and Google, and we needed to make it work and, deal with sort of practical realities of like AI is not going to be perfect every time. So how do we think about complex bounding functions, and how do we make sure that the AI, has some sort of physical, like there's some reality of like sort of the physical world around it, right? What's up, what's down, where's the earth? How do we actually navigate around some situation? And we got regulatory approvals in 9 countries. We're potentially the first autonomous vehicle company to like truly expand commercially to hundreds of clients, get regulatory approvals like around the world, and sort of opportunistically sold it in 2021. Like even just building out the kind of evaluation and testing system needed to be able to generalize, like make sure we had some generalized system, feels very similar to sort of all the eval stuff that people are talking about with LLMs. And, as a core part of what we've built with PortfolioPilot is just how do we assess it properly? How do we have some sort of auditing system to make sure that the advice that we give, we can actually stand behind, even though it's personalized and, there's hundreds of thousands of different variations, that might pop out, the other end of this AI financial advisor we've built.
Yeah. Tell me, I want to look or talk to you about the processing power. Because you're talking about way back when processing power, I mean, I remember Pentium 2. What are we talking, like 300, 400 megahertz? And you were like, I can do whatever. It's my supercomputer. And now the processing power, when you're looking at these NVIDIA chips, it's like, oh my gosh. And the size of them and the power they use. So forget about the energy usage. But way back when, the actual processing power, I mean, it seems to me like you would take rooms full of computers to make these AI models actually work.
I mean, even in 2017, 2018, we had like, I mean, we had an office in San Francisco, and I'd say probably 20% of our office was just like a server room with stacked like NVIDIA GPUs, and like we couldn't buy them fast enough.
Back then.
And like, I mean, we went, I remember like calling up other companies and saying like, can we buy your GPUs from you to like rack and stack in the server room? And it was like, part of it was machine learning and like deep learning training and like these models. A lot of it was simulations as well. Like we needed to prove to the FAA that we could do, millions of collision scenarios and map this out properly in different lighting conditions and different, vehicle configurations and colors and weather patterns. And like, that was a huge part of it. And then the actual like on board, like there's a pre-training, right, to build the models themselves. And then there's sort of like actually running it, the inference time. And so we were doing all this inference on this little embedded GPU called that Jetson chip. And like later we moved to these like sort of embedded Xavier models, and we'd have sort of streaming video in this hardware in the loop setup. And we would have like 100 of our little devices, these like, these little embedded processors and little box we built, 100 of them just on a wall. And they were just like, there was a simulated video stream being fed into these in real time. And then once in a while, it would trigger actions and like a change in the navigation. I mean, absolutely crazy. I mean, with PortfolioPilot, we are now like a fully, fully remote team. Everything happens in the cloud, but like we actually just went through a massive infrastructure upgrade, where like we now have all these dynamic queues and being able to calculate and recalculate recommendations and run through tens of thousands of different potential changes to someone's portfolio and look at market conditions and forecasts. And, we have all these, like, there's one main thing, forecasting model that sort of reprocesses every week. And I think it takes 16 hours to process, across a whole bunch of different services. It's like this parallel computing framework. Absolutely crazy. Probably looks something similar to that server room, if it was physically, here in my house or in an office. Compute requirements have like grown tremendously. And this is kind of like a wild thing. I think a couple of weeks ago, a lot of people were talking about like, oh, now we have this sort of cheaper model. You don't need to train as much. And like NVIDIA stock dropped, which was wild to me because like every single time like we figure out how to do something cheaper, we're 10xing the amount that we're doing it, right? If we can do error checking, in our AI assistant or in some of the recommendations that we do, some of it is just too computationally expensive. It slows it down. People, individuals want to see recommendations generate in, max 20 seconds, right? If you're waiting more than 20 seconds for something to spin, I was like, oh, this doesn't
on to
work.
the next, man. There's different squirrels.
Yeah. Even if it's the most advanced thing, got to load in 20 seconds. And so every time we figure out how to make it a little bit faster, we're just packing more into that. And I think it will just keep accelerating like that. There's never going to be, enough compute.
That's fair. I can tell when I look at the processing power of just a regular desktop now compared to 20 years ago. 20 years ago, when I had to click and you wait for the little spinny circle to do stuff, you're just like, oh, that sucks. But now you look at the processing power now. Anytime I see a little hourglass come up, I think, why? We have 50 times the processing power. There's no reason for us to see that hourglass anymore. Yet, here we are.
Yeah, waiting for a song to download on LimeWire. Like
back in the day,
if it happened in 2 or 3 minutes because we just got some like upgrade to like DSL. Like we just went from, I remember going from dial-up to DSL in our house. I was like, wow, it's taking 2 minutes. This is insane. You know how many songs I'm going to be able to download this week? Like dozens, maybe hundreds. Like this is a game changer. Absolutely wild. I just listened to this. There was like a little dramatization of the Spotify story.
Oh.
And I love that. I forget what it's called, but it was like sort of the Swedish series dubbed over. Absolutely well done. And it was like six different episodes.
I watched that. I watched that because they were talking about the streaming and the delay.
Yeah, like, I mean, the founder just like, it's told like there's 6 different episodes, each like, I don't know, half an hour long. And they're all told from the perspective of someone else on the team.
Yeah, I remember like that was an incredible
series. The first episode is like, the founder saying like, this is how it happened. Here's the story. And then at the end, it cuts to the CTO. He's like, nope, that's not how it happened. This is how it happened. And he tells like the big vision, the big vision is nice, but at the end of the day, you need someone to execute and get Spotify to work, within 200 milliseconds. Cause like, as soon as it drops under 200 milliseconds, then it feels instant. And then at the end of the episode, it's the lawyer that says, that's not how it happened. Like the only reason why Spotify was successful is because, I figured out all the legal stuff. And, I love it, right? There's so many, there's this expression, right? There's like, there's his truth and her truth, and then what actually happened, right? And everyone has their own perception. But like this idea that it's like 200 milliseconds, that's like as fast as human reaction time. And like, you just see the founder constantly saying, it's not fast enough. Everybody else is like, holy, like, this is the Pirate Bay era or the buy CDs era, and Spotify came in and said, like, we'll just give you instant access to any song on the planet. And like, nope, I can still sense a delay. It's got to be quicker than that. And every time they're just shaving off a little bit, a little bit, a little bit. It matters a tremendous amount in human psychology and consumer products. And I think like it's a big, there's so many of these like psychological pieces that I've learned just over the last couple of years. I've talked to thousands of investors at this point, right? And I was talking to someone right before this call. I probably do, 2 or 3 customer calls every single day. And I love it, right? I'm talking to people across America, completely different financial backgrounds, level of expertise using this product. And some people absolutely love it. And how could I have survived before this? And some people say like, I can't believe it's so difficult to use. And like, why don't you put this button on this page? And like, this view isn't the way I want it set up. And so it's tremendous. It's amazing because people have such different reactions. And we made a huge difference recently. It's like night and day difference in the product. As far as we can tell, like the test isn't completely finished, but as far as we can tell, it is a 5x increase in conversion rate to get people to actually start a free trial, like sign up for the product.
Wow.
And it is the difference between, you come in, like basically you sign up for the product, you answer a bunch of onboarding questions, you link an account, and then you come into the product and sort of like see the dashboard. And there's a big banner on the top of the page that says like, check out your portfolio assessment. And it goes through and it talks about like retirement readiness, and it scores your portfolio, and it, calls out what's really good and like where's some opportunities for improvement. And, importantly, it benchmarks you. It compares you to other investors on your age, your net worth, your risk preference. The difference that we made, this absolutely massive change, was preemptively opening this assessment for people or leaving it as just a banner for people to click on their own. Opening it, like, as far as we can tell, like it's going to be a massive improvement. We don't know if it's probably somewhere going to be between 3 to 5x conversion rate.
Wow, that is impressive.
But it's like, this is
the little tiny thing,
psychology, right? I think it's opening that automatically for folks. And because I don't know, people miss it, or it feels like extra work. And like, once you see the assessment, for many people, this is the light, this is the, what do you call it? The aha moment. Like, okay, there's something here. Like, there's something very interesting. This AI model isn't just, ChatGPT. If it's able to synthesize everything here across my life, from taxes to fees to retirement readiness to like calling out opportunities, then, maybe it's worth, actually starting a free trial, actually exploring the rest of this product, versus just saying like, oh, it's just like, every other AI investing product out there.
It's so interesting that you go through, let's say 99% of all that stuff, the technology, the software, the coding, the chips, figuring it all out. And someone's going to say yay or nay based on the color or the font that you chose or the size of the font or where the button is. It's crazy how much psychology can make or break a business, regardless of how good that business is.
It is
insane.
But
I get it.
Absolutely insane. Right? Like we're running so many different A/B tests right now. Like in the last 6 months, I've like become a little bit obsessed with just A/B testing things. I think we've hit a point where like it works, and now it's a lot of optimization, and we have enough volume where it actually makes sense to A/B test stuff. I think when people think about A/B testing, I think we're like oftentimes thinking about like, is it a red button or is it a light red button? This sort of A/B testing. But like we're testing like which image to lead with on our landing page. Above the fold, H1 on our landing page. On our sign up page, right now we have a test that's running that says there's 3 different headings on the sign up page. One of them is like improve your financial strategy. And another one is like the one that's winning right now, and it's like, looks like it's going to improve our conversion rate by about 22%. Instead of improve your financial strategy, optimize your investments. What's the
Oh,
difference between those two? Like they're basically the same thing, but like there must be something that makes like financial strategy feels like just a little bit more technical, feels like I don't, if I'm thinking as a retail investor, I don't really have a financial strategy, but the idea that AI could come in and optimize my investments, that makes sense. Like there's inevitably something I can optimize about the investments that I'm doing right now.
yeah, that is interesting.
It's
Little tweaks like that.
it's
Tell me,
amazing.
I want to shift into the investments themselves. Is
Hmm.
this exclusively for stocks and mutual funds and stuff like that, or does it go beyond into real estate or crypto or other? I mean,
All of the
5 million
above:
things.
fixed
Okay.
income, crypto, real estate, private equity, debt, student loans.
All right.
It's
Put in some
looking at
overtime. I don't know, something like
credit
that.
cards, cash,
All right.
retirement accounts, tax-free, Roth, conversions, everything. I think in some ways it's very contrarian to like the standard startup advice. Like I advise a few tech companies, and honestly, sometimes it feels like all of my advice just boils down to just focus, stop trying to boil the ocean. And that's exactly what we're doing. I mean,
All right. I love
well,
that
that's what we're
saying.
not doing, right? Like we're boiling the ocean. It almost feels like we're doing everything, right? It's comprehensive net worth tracking across everything. It's like advice on all these different things. It's, taxes and estate planning and fees and, investing. And the thing I've come to realize, like we started very narrow, just ETFs and stocks, investing recommendations. And then like I still remember 2 years ago, I was talking to this guy, I was showing him like sort of one of our early like sort of beta models, sort of everything was working technically, but we're like trying to figure out how do we actually give the financial advice to people? How do we show people recommendations? We weren't charging for it yet. And this guy had $900,000 net worth. 40% of it was in Tesla. And the system told him, you should sell 80% of your Tesla position. Feels like no brainer financial advice, like for so many reasons. It's not efficient and nowhere close to the efficient frontier. There's lack of downside protection. And you have like all this, you have all this idiosyncratic risk, in an individual investing position. And he said, no, ignore. That's a bad recommendation. And I'm like on a call with him, and I'm just sort of like, hey, let me watch you use the system, react to the investing advice. And I asked, like, why did you press that button? And he says, I'm not going to do that. That's crazy. Yeah, I have $350,000. I'm not going to sell $300,000 of Tesla. And so, okay, like, do you think you're in is your portfolio set up in exactly the ideal way? He's like, oh, no. It's like super problematic that I have all this Tesla. Like, okay, why don't you take the advice then? He's like, well, I'm going to pay a whole bunch of taxes on this, first of all. And if I sell it, I'm not just going to sit on cash. And so I need to figure out like what to trade into. What am I going to invest instead of Tesla? I'm not going to buy bonds. I'm not going to I'm 28 years old. Like I'm perfectly fine taking a whole bunch of risk. I'm probably going to end up putting it in Meta or Google, or like it's basically going to be like 90% similar correlation to Tesla. It's going to be some, you know, Mag 7 type, growth stock. It's going to have like, if the market crashes, Tesla's going to go down and Google's going to go down at the same time. Like, am I really more diversified? All I'm doing is just wasting a whole bunch of time doing research and, paying taxes for like a similar exposure, and like digging into it a little more. His uncle worked at Tesla, so he kind of felt like he had a little bit of
All
insider
right.
information. And like, I mean, there's all these things that you need to consider before you like someone will actually take investment advice. And so after probably 6 iterations with him over the course of the next 6 months, him and a couple other investors, that like the advice that he actually ended up taking was something along the lines of like, sell 5% of your Tesla position. Here's the taxes you're going to pay. With that money, you should buy this like commodities index fund. It's everything from like oil to like wheat. And it's like, it's an ETF, it's a low expense ratio. It's going to do wonders for your downside protection. Here's like a metric, showing you how your downside protection is going to increase. It's going to make your whole portfolio more resilient. Here's the expected return, basically the exact same, but the efficiency of your portfolio goes way up. And he said, okay, that actually makes sense. Sort of, it checks all the boxes. I could trust that it makes my portfolio a little bit better. The taxes, I can swallow that. That's sort of like a one-time hit. And you sort of need to do everything else to get one piece of advice correct for someone. You can't just tell, I think this is the biggest problem with any company like Motley Fool that's just saying, well, NVIDIA as a buy today or NVIDIA as a sell, it's undervalued. Whether you, James, should buy NVIDIA or sell NVIDIA is very personal to your preferences and what's in the rest of your portfolio and what you care about, and whether you're gonna buy or sell your house next year, or what are you saving for, how your age and how close you are to retirement, and so it's like you kind of need to do all the things. I think about a lot like this iceberg, right? There's so much under the surface that you need to think through before you can give one very simple piece of financial advice to someone that they will actually trust and and act on.
Fair. Tell me the learning model. When I look at the market over the past, let's say 50 years, it's doing whatever. But then it seems to me pandemic-ish is when it starts going crazy roller coastery. Like before there were roller coasters, but our idea of a roller coaster even 10 years ago compared to today, we're talking plus or minus 5 to 10% over the course of a month, where 20 years ago people would be screaming, and now we're just like, hey, it's going to come back up. It's not a thing. So how do you teach a model that this is what's happening because this is the way the world is going now versus 20, 30 years ago? That's the way the world was with the market. I don't know why, if it was more retail investors got in or what happened pandemic wise that it started to become so rocky. I have theories, but I don't know. I'm certain you know more.
There's two parts to this answer. I think it's a good question, right? And I think the short answer is, as far as I can tell, based on a lot of the work that we do with these historical trends, things aren't any more volatile these days than they were 20 years ago.
They're not.
No. And
so you can look at the graphs and there's definitely, it's a 5-year-old with a crayon right now.
I honestly think, I also feel that. And I honestly think it's just in our head. We are just we remember the past differently than we remember now.
You look at a graph of the S&P 500 and it's dramatic.
Well, okay, this is if you weight it, if you take a log graph, I don't think it looks very different. It's exponentially larger, and so the swings look larger.
Okay.
But looking back over time, the markets aren't really more or less volatile than they were before. And I think it's feels like just a hindsight bias. Maybe it's just when you look at the graph, exponentially feels like it's large, the magnitude swings are larger, but the relative swings are the same. And then, practically the system is looking at historical volatility, recent volatility. We have this exponentially weighted model for how we assess volatility. So it gives a little bit more weight to recent events, but then we also tie it to macro trends. And so every single forecast and prediction and volatility model, and if we're analyzing, correlation and betas and everything like this, it's all tied to macro trends as well. And so we're tracking something like 20,000 different macro series, from US GDP to, Canadian CPI to building permits in South Korea. These are all sort of publicly reported, macro indicators that all connect together in a way. and as much as possible, you want to try to find leading indicators for like how things are going to happen, right? And like if you make the model big enough, you can capture more and more of these sort of like these edge cases, and you start sensing anomalies, and all of that gets fed through to like the underlying risks and expected returns for the portfolios. We, as much as possible in like what we what we design into the core system, we try to make it as accurate as we possibly can, even if we have to sacrifice some precision. And so what you'll see is sort of like the more uncertainty there is in the world and markets, what happens oftentimes is that the uncertainty in the error bars in our own models and forecast grows as well. And that means that the expected return to volatility trade-offs that it's making, like this risk-adjusted return component, ends up getting worse and worse and worse, like as you go into recessions and more volatile periods, which is a really good thing in general, because that feeds into the recognition engine and ends up being threaded through to like your individual financial advice.
So how far back is the model looking? Is it going 1900s, early depression?
Yeah, it really depends on like which series, but I mean, we have data sets that go back really, really far. I mean, definitely like well into the 1900s, deep into the 1900s.
Okay.
I don't know if we have any data that like goes back to the 1800s. Maybe there's some gold stuff that is like that far back, but like I think you definitely have like there's certain moments over the last 200 years that have like really defined market conditions, and like there's like the creation of the SEC, and like thinking about all the stuff that happened after like the 1929 like the Black Friday and the stock market crash and a lot of the regulations that came in. Things changed tremendously after World War II in markets and like population boom. And then things really changed again in 1970 after the moving off the gold standard. And
oil embargo and
a lot of it, I think, like it's really difficult to like trust trends like going back before 1970 in particular. Like I think most people, most economists, most people like in the investing world are really just thinking about like the last 55 years as sort of like as far back sort of in the current regime.
Fair. Yeah, I think it was a different game when computers weren't really involved. You look at the little videos of our oh my gosh, the depression stuff when they had the tapes and the price couldn't keep up with the speed of the tape.
Right.
So people would make a trade, but it was so chaotic. And I was thinking, man, they did that without computers. Where today,
what an absolutely different world. Even one of these books behind me here is it's a book called Flash Boys, and like it's basically all about like getting closer to the exchange, and
I watched
microseconds like start to matter, and people building cables, and like people realized that like they were running a trading business, and they realized that they were getting different prices from different exchanges. And depending on which exchange you sent your orders to, you could sort of undercut other exchanges. And there was like this arbitrage opportunity happening in milliseconds. And they ended up creating this like completely separate exchange that executed everything at the same time to make it sort of like a little bit more neutral for everybody, like all market participants. And like that was a big deal, because like in their trading business, they realized that there was all these high frequency traders that sort of like undercutting all their trades. And so they were trying to figure out like how do we set a level playing field so that we sort of negate the effect of all these high frequency traders. And absolutely fascinating. Sort of like as you dig down, I mean, you keep digging down, right? There are arbitrage opportunities on like the systematic macro fields that like hedge funds like Bridgewater are playing in. And then there's sort of like day-to-day dislocations. And I've talked to data providers that will like I mean, they promise to, give certain anonymized credit card data for retail transactions so you can bet against, Target announcing earnings, a day ahead of time, based on credit card data. Wow. And then like you get closer and closer, like lower, down, and like it matters which, if you're running an FPGA or like a CPU, and like how many feet away are you from the central server to the New York Stock Exchange. And it turns out that the stock exchange is obviously in Manhattan, but all the servers are across the river in New Jersey. And so like all the buildings, like some of the most valuable real estate in the world is actually like the buildings right around that exchange. And then even the New York Stock Exchange, like a number of years ago, realized that they could actually start clearing away offices in the building itself and just let people co-locate their servers like a floor above the central servers. Wow. And that was incredibly valuable real estate. And then they started clearing away space like around, like in the room itself around the servers. Absolutely wild.
Yeah, I remember watching a documentary about them running a cable. I want to say Chicago, New York, something like that. But it was interesting because how much time, money, and effort they went in putting that in, and it was all a game of fractions of a second. But it's just like you're talking about that arbitrage where they're essentially somebody makes a trade and they're shaving off that little thing every single time you make a trade.
Yeah, and this is obviously like high frequency traders with tens of millions of dollars or more, on Wall Street. And I mean, probably some of the smartest people in the world doing that. Like knowing all that, I actually think it's very difficult for retail investors to believe that they really have some opportunity to beat the market.
Agreed.
And,
totally agreed.
I mean, I think this is like a big part of the motivation for us as well, right? Part of it is just education. Part of it is helping people think about asset allocation. How do we rebalance stuff? How do we get these other optimization opportunities around taxes and scenario planning? And, if you could just shave off fees, that might be the best thing that you could do, over the next 30 years,
Yeah.
Even if you miss every single, major trade and, you miss NVIDIA, like could be the difference between having, $1.6 million, in retirement and $800,000 in retirement.
Yeah. It's interesting. I had a financial planner way back when, and I learned about Vanguard funds through the John Oliver segment, which you probably know way back when.
Yeah, exactly.
And I looked at what I was invested in with my financial planner guy, and he just had me in index funds.
Right.
And so I looked at Vanguard index funds and I saw this like, what the hell? I'm paying this guy 1.5%, whatever it was. So I moved all my stuff. And he calls me up and he's like, James, what's going on? I saw you moved all your stuff. What's going on? And I'm like, hey man, you got me in index funds. I just moved it to index funds because I can just do that on my own.
Right.
And he's like, no, man, but I'm your guy. And I'm like, okay, you're my guy. That's cool. Great. If you can tell me the value that I'm getting for that 1.5%, I'll switch it back right now. And he couldn't.
Yeah.
And he's like, no, you can call me anytime. I'm like, for what? For what? There's no reason I need to call you. I don't want to call you.
I read a report recently that said that in 2010, the amount of 40-year-olds that were using a human financial advisor was something like 50%. Now it's down to 30%.
Wow.
Like for 40-year-olds, today.
Yeah.
And I don't know, I talked to millennials and Gen Z in particular, like, I don't know, there's just a distrust in institutions. There's more than enough, brokerages that are offering solutions like this. I think a lot of shows like this, right? That like tell people like, hey, you can do yourself. Like you got to justify the 1% fees. Like I have no idea what's going to happen to this, $240 billion human financial advisory market. And I honestly think it's doing well, mostly because people are living longer and there's sort of just like the baby boomers and older generations that are like accumulating wealth. And I think as soon as it gets passed down, this industry, just like something needs to replace it. And like, that's our big bets, right? They're like, people still need and want guidance and financial advice. And if I'm doing it myself, wouldn't it be nice to get a second opinion assessment? And like, I mean, that's like our big advantage, right? Like that's sort of the big macro play here. Like why I can't imagine that there won't be lots of competitors. And if we fast forward 10 years from now, everybody's going to have some personal AI doctor that they consult and a personal AI lawyer that works with them and a personal AI financial advisor that is just like constantly looking out for threats and opportunities. And like, they're mostly just in the background. I don't need to chat with them like I'm, pulling up ChatGPT, but an email, an alert, a notification every once in a while. Maybe some simple automations as well. I don't know, I feel like it's so hard to imagine a future that isn't like that.
Fair. Totally agree. Yeah, AI changed the game. Is changing the game.
Yeah.
Yeah, very true. Alex, where can people find you?
Honestly, obviously would love for people to sign up for PortfolioPilot.com and, feel free to shoot me a message on Twitter. Always, I feel like that's the go-to place. Reach out to support. We're like constantly trying to get feedback. Truly, it's like we're trying to make it simple but powerful, right? That's the mantra in 2025. And it's all these little optimizations in the interface and how do we deliver the advice. And yeah, Portfolio Pilot is the Twitter handle, or my personal Twitter handle is or X handle, Alex Harm, HARM.
Simple. What did you call it? Simple but powerful.
Simple but powerful. Yeah,
I love that. That's awesome.
James, thanks so much for having me on.
Yeah, Alex, thank you. This has been Authentic Business Adventures, the business program that brings you the struggle stories and triumphant successes of business owners across the land. Downloadable audio episodes can be found on the podcast link found at drawincustomers.com. We are brought to you by Calls on Call, offering call answering and receptionist services for service businesses across the country, on the web at callsoncall.com. And of course, the Bold Business Book, a book for the entrepreneur in all of us, available wherever fine books are sold. We'd like to thank you, our wonderful listeners, as well as our guest, Alexander Harmsen of PortfolioPilot.com. Alex, can you tell us that handle one more time?
Yeah, just Portfolio Pilot.
Easy enough, man. All one word, no dashes, no lines, whatever.
All one word.
It doesn't get easier than that. I love it. Past episodes can be found morning, noon, and night at the podcast link found at drawincustomers.com. Thank you for joining us. We will see you next week. I want you to stay awesome. And if you do nothing else, enjoy your business.